Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Chuck Fuller, portfolio manager with Nasdaq Dorsey, Wright, to discuss if most of the bad news may already be priced in. And Chuck, certainly that's what everyone is talking about. Have we hit peak inflation? Have we hit the bottom? What are you seeing with your indicators that could potentially suggest this news may be priced in?
Yeah, I mean, obviously, the May inflation print that we got in June, caused a big sell-off. This time we got an even worse miss. And we've mostly rallied since then. So that's a good sign. It means that hopefully, most of the news has been baked in. Although, we have seen some deterioration in some of our indicators, some of our longer term indicators. So we have what's called our Dolly system. It's basically an asset class ranking system. Usually when, US stocks are doing good, they're, number one, number two out of six. Now they move down to number three. We have cash now at number two. So that's not a great sign. Although sometimes we'll see the market bottom around these levels. So that's, one possibility, but usually when it moves down to these levels, we're worried about, potential for further declines, like we saw in maybe 08 or 2000. But I will say, some of our other indicators that are more kind of breadth based are very washed out right now. There's one in particular, basically it's called the NYC high low. Looks at, stocks hitting new 52-week highs versus 52-week lows. It's about as low as it gets. And usually when you see a reverse up from these levels, you get about, 20 to 25% returns over the following year. So we're pretty close to seeing that happen. So, from that standpoint, we're hopeful that, the market's going to turn around. I think the question becomes, is it a bear market rally or is it the start of a new bull market? That's what we don't know. And, we're going to have to see some of these things start to hit, break out into new positive trends, things like the S&P, the NDX, they're getting close to their trend lines, their negative trend lines. So if we can, see the S&P, for instance, pop up around 4,100, 4,150, somewhere around there, that'd be very constructive.
And Chuck, let's break it down further with sectors. We know energy was the shining star this year, but you're seeing a reversal in a number of those earlier trends in the first half.
Yeah, that's exactly right. So yeah, like you said, energy is up huge. I mean, basically it's the only sector that's done really well this year. But in the last month, it's down 25%. And a lot of that's because a lot of these recession fears are starting to get stoked. And of course, less output means, less demand for energy. So yeah, you've seen those really take a hit. It was number one in our rankings. It's fallen to basically the middle of the pack out of about 11 sectors. And we've seen more defensive sectors kind of take its place. So things like consumer staples, utilities, things like that are now at the top of the rankings. But we are seeing some movement out of kind of like the former leaders. So things like technology, consumer cyclicals, all those kind of former leaders. They're at the bottom of the rankings. They've been there for a while because they've obviously gotten hit pretty hard this year, but they're starting to move up off the bottom, and so that we're hoping to that will kind of lead to a new kind of bull breakout, but kind of remains to be seen. It's kind of early days right now.
And what about fixed income? Are you getting constructive here at all?
Yeah, we're starting to see again some signs of life. Obviously, it's terrible market for fixed income. We're down 10% for the year. I think we mentioned in another trade talks that it's the worst start to a year for U.S. bonds since like 1788. But in the last month we have seen a couple buy signals form off the aggregate bond indexes chart. Doesn't mean we're out of the woods. We're still well below the kind of the negative trend line there. But it's kind of the first first thing that has to happen before you see a turnaround. So we're cautiously optimistic. We're also seeing, fixed income in our asset class rankings gain some strength. It's been a number 4, so kind of right under domestic equities. But the number of signals that it has been gaining. So it's actually pretty close to overtaking U.S. equities, which obviously isn't good for U.S. equities, but is good for fixed income. And we've been seeing, long duration treasuries starting to show some signs of life. Those are ones that usually are most sensitive to interest rate risk. So with interest rates moving down a little bit, from their peak, they've kind of perked up. So that's another sign of cautious optimism for us. But we're definitely not out of the woods.
And finally, Chuck, commodities are still ranked number 1 in the asset class rankings, but they've had a pretty tough time over the past month as well.
Exactly. Like we said with energy, energy being a big part of the commodity space. They went down 25% from the peak, but still ranked number one, because they've had an incredible last couple of years. So the relative strength is still there, hasn't bled out, at least versus other asset classes. And plus commodities are very volatile too. So, seeing a 25% hit like this, it's bad, but it could easily turn around. But we're also seeing some other areas of commodities that are, acting a little strange too. Gold is supposed to be an inflation hedge, but it's down, 16% from its peak in February. You have kind of economically sensitive commodities like copper are down almost 40%. We've got a war going on in Ukraine right now. You would think that the price of wheat would be through the roof, but it's down 40% or close to 40% since its peak. So it's, like I said, they're still ranked number one, but yeah, they're having issues, and I think obviously a lot of that comes down to recession fears.
All right, Chuck, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq.